Parker. I lead the corporate finance business at Parry. I've been working in deals for 30 plus years, and I never cease to be reminded of that famous curse to be living in interesting times. And the last 3 years have been pretty interesting as far as deals are concerned. What I'm going to do today, just say a little bit about what we're seeing in the deals market at the moment, what's happened over the last 2 or 3 years, how that is impacting on pricing or valuation of businesses, some of the key sectors that we see as still very, very interesting for the market, and then perhaps some suggestions of what we might see coming into 24. So what are we seeing? I was looking at this slide again and just thinking, actually, if I wound this back to 30 years ago, we'd see a number of peaks and troughs, that interesting market that we keep seeing. So this is the number of deals that are happening in the UK market over time. And what looks like a really big peak up here in around here, 2021, whereas first half of 2020, COVID, we were all sitting there thinking, what on earth is going on now? Where are we going? Is anything going to happen? We as a team had 9 deals on. 5 of them, well, I'd say disappeared. Actually, most of them have come back, but moved off to the right. There's no way those deals were going to happen. But 4 of them did happen in the next 6 months to 12 months from there. And suddenly the pricing on those deals went bananas. Everybody wanted to invest in businesses. And okay, we had some interesting businesses in there. We had some professional services businesses in there. We had healthcare businesses. We even had a toilet tissue manufacturer. At the height of COVID, everybody remembers the frenzy for toilet paper. It was an interesting time to be doing a deal on that. But what we saw, this boom, and part of it, and again, Mark is the economist in the room. I'm just somebody who tries to interpret things to try and give a message to people. What we saw, interest rates were very, very low. There was stimulus coming from governments all around the world, and people were looking at assets to invest in. And that particularly came through as not only companies, but also private equity really strongly investing in assets at that point. And then we came into 22, and suddenly we had Russia invading Ukraine and the huge impact that had on energy prices around the world, which has such a knock-on effect to every other business, which changed the appetite for doing deals. Again, a time of reflection, of seeing how are things going to work out. And that has sort of spun on over the next year. We also had, of course, our very own comedy show of Truss and Kwarteng trying to shoot the British economy in the foot. And then again, going forward, we have more conflict. So interesting. But even despite that, you look at where we are now in 23 compared only 5 years ago, it's about the same. So actually, the long-term average, it's an okay market. It's not a bad market. It's not a fantastic market that's booming and going crazy, but it's not a bad market. Lots of data on that slide from sources. The key thing that I try and sort of point out is actually what's happening on a trend, and the sort of the buff-coloured line sort of shows this is about sponsor-backed or private equity-backed deals that are happening, and this is globally, but it's the sort of continued growth of private equity in the marketplace over the long term. So this is over 12 years. we go back even further, more and more private equity going into businesses, into deals across the world. Just go back to that. So what does that mean? Well, it means that there are lots of companies still doing deals and buying businesses, but there's this whole new investment pot, if you like, of money out there backing businesses. And as we come on, it's even more important in the mid-market, if you like, the privately owned businesses where the UK sits. So some of the key themes that we're getting on deals at the moment: debt has shifted. Again, roll back 2 years and we were at virtually no interest as a base rate. So banks were charging a bit of interest, a bit of a margin on there, but it was very low. It meant that the cost of servicing debt was very low, which meant there was loads of profits for them to feel comfortable to lend a decent amount into businesses. As interest rates have gone up, it's increased risks, and it's also increased the cost of servicing that debt. So the banks have just pulled back a little bit on the amount that they're going to lend into deals. There's a valuation gap. I was speaking to somebody earlier. They'd been looking at a few businesses, but just couldn't quite get there with sellers of businesses. And this often happens as you're coming off this peak of deals where people are thinking they should be getting the multiple that was there 12 months ago or 18 months ago. Whereas the dynamics today, if you're buying, is you actually don't want to pay what people were paying silly prices 2 years ago. So there's an expectation gap, and it takes a little while for that expectation gap to close. So we are seeing that in the market at the moment. The last one, I'll just pick out lots of data on that slide, but due diligence process. Again, risks are perceived to be a bit higher because there's change. There's change in the economy, there's change in the global economy, there's change in the debt markets. So that means risk has gone up. And what we're seeing where people would still do the same diligence a year, 18 months ago, they would look at a thing, review it, make a decision. Now they're looking at twice, 3 times, 4 times the same issue before they get comfortable. They want to see the next set of management accounts just to check the KPIs are going in the right direction. And then, that one didn't quite go. Can we have the next set of management accounts? So suddenly you're adding 2-3 months into a deal process. And so things are elongating in terms of time. So that due diligence process is taking longer. Private equity, again, so here we've got, this is top graph here is looking at the debt to equity ratios that are happening in private equity backed deals. And so we're seeing here that the amount of debt going in has dropped quite considerably. And that gap is being filled by private equity money. So the equity portion of the deal is getting filled up by private equity. And we'll come back to this as one of the features going forward, but they've got a lot of money to spend. They've raised a lot of money over many years. But what we're also seeing in this bottom chart here is that those private equity houses are probably moving away from some of the really big deals, the platform deals, because they're quite risky as well. They're going into a new business. They've not been in before. They don't know everything about it. There might be some skeletons in the cupboard that they're afraid of opening up and finding walk out. So what they are doing is backing their original investment with more money to do bolt-on acquisitions. So got the platform, and now let's go and find, and we'll go and get some growth by adding smaller businesses on and adding those on into that platform. Cooper Parry might be a really interesting case study, as we've done 6 deals in the last year. Again, bolt-on businesses that help grow the business, but because the platform, everybody, Waterland, our private equity investor, knows Cooper Parry, they're really keen to support that growth through further acquisition. Flip on from that one. So, pricing. This is quite a drop-off suggested here in terms of pricing in the last, so TTM is the trailing 12 months. A drop-off in average pricing for deals less than 100 million. This is from PitchBook, which is a data source that looks at deals. They only capture what people will give them. So there's a lot of data that isn't published, but I think what I always look at is what's directional. So pricing has come off in terms of some of the deals that have been concluded. Part of it is because some of those really attractive businesses haven't transacted because of that vendor price expectation gap. The vendor wants a price up there. People are not quite prepared to pay for it at the moment as they're going through the risk cycle. That will start to close, and I think that will start coming back up again. In terms of some key sectors that remain really hot, I'll talk through 3 of those. Why are they hot? Well, in the UK, the market that we serve, which is the mid-market, so deals up to about £100 million worth of value, the 42% that we saw global private equity-backed deals is actually much higher in this up to £100 million space in UK market. It's more like 60% of the deals. So the sectors, if more than half of the deals have been done by private equity, we tend to look at what do they want to invest in. And so the 3 sectors I'm going to pull out are ones that private equity continually want to invest in. And they're driven by a number of factors. Healthcare, demographics, massive change as well in the way that healthcare is being delivered, use of technology within there. So if there is demographics, if there is tech enablement, if there is regulation around it, compliance requirements, that is really, really attractive to private equity investors. So healthcare, again, interesting to see that on here, the pricing, so this is the bottom chart, the pricing on that in the last 12 months has actually gone back up again after a period of just dropping off. So where investors really want to go, the pricing remains high. These are a few of the deals that we've done recently. Again, technology or technology-backed businesses, again, that pricing has started to pick back up again. And this is on software, so we often use revenue multiples or recurring revenue multiples to measure that. But I was talking to, again, a private equity investor couple last week, where they're talking about a polarization in the marketplace. Some businesses which are okay businesses, the pricing is still quite tight, it's quite low. But the really, really attractive ones, so they're going to be ones where really rapid growth, very high margin, a sustainable high margin, repeat customers. The pricing is actually really intense. The competition for those businesses is very, very intense, and that's pushing pricing up again in that marketplace. So there's that polarization where average businesses, pricing is going to come off. Really high quality businesses are going to go for high prices. And again, business services, again, we're seeing that just pick up in that last element where people pause for breath. All the issues we talked about in terms of Russia invading Ukraine, UK political situation, pause for breath in 22, but picking back up again over the last 12 months. And again, Parry is a very interesting example on business services of deals happening there, some of the other deals that we've been doing. So is 2024 going to be an absolutely bumper year for deals? I don't think it will be. I think we're in that flattish sort of marketplace, an average sort of year. Deals will be done, but the appetite is going to be really strongly on certain areas, certain key sectors. Private equity are going to be pushing to do deals there, but there'll be deals done elsewhere. The pricing gap is going to continue. Private equity have got more money raised than they've spent. The gap between the money they've got raised, ready to spend, is higher than ever. So they're going to keep going on investing. We also, I think, and again, Mark may contradict me, but I think we're in a relatively stable sort of position in terms of interest rates. If I look at swap rates, so the rates that are looking at sort of 3 years, 5 years, 10 years, we're still coming down in 10 years just over 4%. We're maybe at 4.6% or something at the moment. It's pretty stable, slightly going down, but that's normal. So people can take decisions and look at planning over the longer term. So I think that's a helpful factor. And as well as private equity having money, we also have quite a lot of cash-rich companies. So they may be pausing to just check that everything's okay and so on. But I do think that they are going to be participating in the market in buying businesses. So it would be great from Adele if for the next election, everybody's saying that capital gains tax is going to go up and that might stimulate people to bring their businesses to market, to cash in quickly. Probably won't happen. But I think 24 will still be a decent year for doing deals. You will need to do your diligence, whether you're buying or if you're selling, getting prepared, because people will look 2, 3, 4 times. But business will continue, and I expect a good volume of deals. Okay, thank you.